Our feature article is the different share price performance between Ford and GM compared to auto parts suppliers during the resurgence of retail auto sales over the last 7 years. In this article we ask, if not now, then when? For the last 28 quarters since December 2009, unit retail auto sales in the US have grown at an annualized rate of 7.8%. The auto market has benefited from the perfect storm of falling unemployment, increasing household income, rising construction and falling gas prices, which has led to year after year of rising auto sales. However, since the relisting of GM on November 18, 2010, total returns to Ford and GM shares have been -5% and +22% respectively. In contrast, the median total return to 9 auto parts companies is 92%, which translates to an annual return of 11.1% over that period of just more than 6 years. The difference in performance is not cyclical, as shown by 2 distinct time periods. During a year and a half of declining stock prices, investors in Ford and GM lost 44 and 45% respectively. In contrast, the median return to the auto parts suppliers was -20%. The auto parts suppliers then continued to outperform during 4.5 years of recovery. Over that period, Ford and GM share market returns were high. They were 12% and 19% per year. However, the median annual return to the auto parts companies was 27%. If a market cycle can't explain the difference in performance, we need to look at structural factors facing the industry. The share market performance provides a window into the competitive pressures facing the automakers. During the last 7 years, revenue growth has fallen behind sales growth and margins have declined. Yet the opposite result holds for the auto parts companies, whose revenue growth has kept pace with the growth in unit sales and whose margins have improved over time. The margin pressure is further highlighted by commodity price changes over the 2 time periods. Aluminium and steel prices have marched downwards since GM's relisting, but any gains from lower input costs have not shown up in margins. While competition has kept a lid on earnings, Ford and GM have made considerable investments. Around half of earnings per share is returned to shareholders via dividends and share repurchases. But that cash distributed to shareholders has been more than offset with new additional borrowing. It is challenging for very large companies to grow at high rates. Yet the recent investments by Ford and GM are consistent with high growth aspirations. The challenge facing the automakers is that those growth aspirations are not reflected in either the share price performance or in analyst earnings growth expectations. Earnings expectations for the automakers are flat for the next 3 years. Yet for the auto parts suppliers, expectations are real terms earnings per share growth of around 5% over the same time period. The auto industry is undergoing its next evolution with increased ride sharing and progression towards autonomous vehicles. The impact on unit sales from that transition is unclear. On the one hand, ride sharing should lead to increased utilisation, which would lead to a decrease in unit sales, somewhat offset by the fact that we should be turning over those vehicles more often. On the other hand, it's not unforeseeable to see a massive increase in ride sharing displacing some mass public transport. What the data from the last 6 years show, both in terms of revenue growth, margins and reinvestment, is that the ability to maintain margins within a supply chain is crucial for improving share price performance during that transition period.